All right, well, for some more thoughts on what's going on in the bond market and how that's clearly affecting equities at the moment, Shawn Hickman joining us. He's a research lead at Market Matters. Shawn, good to catch up with you again. So we're seeing those yields continuing to march higher, in part, given what's going on in the UK at the same time. What's the broader effect of that?
Bond yields go up, equities go down. Most people watch this show and know what we think about shares. We actually like shares, as you know, for the last month talking to you. But until the bond market stops going up, takes a rest, it's hard to see equities really take off. And there's a lot coming up. This Thursday, US CPI, people are scared about that. 2nd of November, the Fed make the next policy decision on rates. People are nervous about that. So until we jump over these hurdles, the market's very unlikely not to be volatile and choppy, just like it was last night. It was up, it was down, it was up, it closed down. I think we're going to see more of the same, a nervous market. But bond yields have also gone a long way. They're building a lot in already.
Yeah, well, do you feel as though they still have more or further to travel north, given, well, you particularly look at the terminal rate in the US, which is pretty much regarded, given what we've heard from the Fed members, that sitting at around 4.5%.
I think what we're going to see is it's time for a rest. So, you know, they've done a lot, they're doing a lot, as we both know. And then they're going to pick a time, like the RBA did this month, and say, okay, let's see how much we've done to the economy, how much damage we've done to the economy next year. The RBA is a little bit different. Obviously, they're nervous about how many how many mortgages come off fixed rate next year. The US want to see how the wage pressures start to ease off, etc. We saw signs of that, or glimmers of hope of that last week. Equities surged for their best gain in a long time. Yeah, but I think overall, we're going to get to that point where they say, okay, let's take a rest now, let's see what happens.
Well, I mean, the problem though, you've got that lag, haven't you? And in fact, we heard from Jamie Dimon from JP Morgan talking about the expectation that he thinks the US will be in recession sometime next year by the time those rate effects really come into play. So, I mean, would you agree with that? And, well, further to your point, I guess, if the Fed goes for a pause, that's likely to light a bit of a fire under equities, isn't it?
Well, they're not going to pause next month.
No,
but they will at some point.
That, when they do pause, yeah.
Absolutely, and I think they're going to flag it when they do. You know, it's not going to come out of left field. Do I think the US will be in recession next year at some stage? Yes, quite amazing if they're not. But a recession, is it deep? Is it just a slowdown? What are we going to see? Is it going to be sharp? Is it going to be painful? There's lots and lots of different versions of a recession. And that is what the central banks are trying to engineer. A soft landing by killing inflation. It's a very hard game for them to play.
All right, so given that ongoing uncertainty then, are you buying right now?
Well, you know we are. I've said that for the last few times.
I just wanted to be sure that you're still doing that.
No, absolutely. But it all comes down to time frames. You know, we are not traders. We're investors at Market Matters. But the market is doing some huge cycles over 2 or 3 months. It's doing what it would normally take 2 or 3 years to do. So we think the market will be higher at Christmas. Do I think the market will be higher in a year's time or 18 months' time, as I said to you before the show started? Probably not. So I think we have to be cautious, very, very cautious, recognize where the market is in the cycle. And it's a very nervous market. You know, it wasn't long ago where everyone was looking, oh, we could have bottomed, we're off and running. And our market still could have done, by the way. But the US market last night, the NASDAQ made new lows again for the year. It's still very, very nervous, and it needs to jump through some of these hoops before it comes out the other side. All
right, so where are you seeing that value at the moment? What are you willing to buy? Are you venturing into speculative territory here, or are you confident about what you're picking up?
No, I mean, the speculative stocks could run harder, but I'd rather avoid them. We'd rather be in the quality end of town, at least stocks that we're happy to hold for the longer term, that make profits, pay dividends, etc., etc. It sounds boring, but I think we have to be prudent where things are. We're still trying to catch a falling knife, really, in some regards.
So what are you liking at the moment?
Well, I mentioned that too. I think the tech stocks, the quality end of the tech stocks we've bought, you know, SEEK and REA over the last few weeks. At the moment, they're looking okay. They're not falling any further. That's good. Whether or not they can take off, I think they will, but time will tell. So the quality end of each individual sector. So we think tech's fallen too far, but it doesn't mean you go and buy the whole tech stock. You don't buy it necessarily by the ETF. You pick out the ones you like.
All right. How are you feeling about the financials at the moment, particularly the big banks?
Okay, well, UBS came out yesterday and upgraded some of them. You may have read that. We like them. We like them into Christmas. They're going to pay a good dividend. 3 of the big 4 in November will pay a big dividend. And I think they'll be higher come Christmas. So if you can capture a nice, fully franked dividend, Westpac, for example, I think it's forecast to pay about 61 cents, fully franked, approximately a month's time from today, and the stock's higher by Christmas, that's not a bad return, especially in today's environment.
How are you feeling about the commodity space, where those prices are going, and are there any particular stocks that you like there?
We're still long IGO. We think IGO is a really quality stock. It's obviously the nickel play. It's got lithium coming on down the track. Lithium area has been fairly hot, but as IGO makes new all-time highs, we think there's enough going on under the surface in terms of a quality acquisitions over the last couple of years to put that stock to say, if you want exposure to that end of town, this is a really good quality company. Sure, it might come back. A lot of stocks have come back and up and down on their way up, but it's a quality operator that we like holding.
So you're liking the diversity there, clearly.
Yeah, a bit of diversity. It's also new energy,
Yep.
which is real. It's very real. New energy is very, very real. I went down to the Woolworths car park yesterday, and there's the Tesla charging stations.
Yep.
They weren't there last week.
Right, okay, well that's interesting. But what, that rather than some of the pure plays, be it in the lithium space, for instance?
If they're making a profit and delivering,
Yeah.
yes. But I think IGO has also got the nickel growth, funding its move into further nickel development and further lithium. I think that's where you've got some excitement. In that particular
it's funny,
stock.
isn't it? Because all the concentration there at the moment in battery metals is on lithium, but I mean there are so many other elements that go into, you know, nickel, copper, cobalt.
Oh, copper we like as well. I mean, copper is the Dr. Copper, as it's often called, is the bellwether of the economy. And it's come back a long, long way as everyone looks at a recession. But
Yeah.
that's still got a lot of copper goes into the new batteries at the moment.
Yep, all right. And finally, Aristocrat. You're liking that, why is that?
Well, that comes under that umbrella of quality tech stocks. It's highly correlated to tech, even though it is fundamentally a gaming machine producer. Some ethical investors might not like the stock, but it's come back a long, long way. I think it's almost 40% from its highs of last year, but it's held really, really well over the recent months when the rest of the tech sectors plumb new lows. And we think the next 20-25% is up in that stock. It's again, it's at that quality company in a sector that's been battered up is worth having a look at.